How's the economy going to do in the third and fourth quarter of this year? Sadly, it's going to get worse before it gets better. There's really three things we look at: GDP, central bank policy, and then in this case, political risk. GDP has been worsening. Q4 of last year, Q1 of this year weren't that good. Folks were hoping that Q2 of this year was going to be better, but it's not. So that means we have a very clear downward trend there. Now, central bank policy, interest rates, and so forth. Yes, central banks have started to ease, but we're not starting from very high. It means we don't have that much to go. Our central banks don't have that much to go in terms of loosening. So when we get further in this cycle, how low can they get? And we all know that it can be very low, but there still reduces the number of options we have. Then there's the issue of political risk, and that's really where everything is getting very difficult. We've all heard about Brexit. We've all been following it for 3 years, but this is when October, this fall, is when Brexit comes to what's going on there, and it's not going to be a clear-cut decision. Is going to be messy in the meanwhile, Parliament and so forth. And then there's new risks that are emerging. Hong Kong and what's going to happen there, the protests, and whether there's a hard response on the part of the mainland, that's going to be a tremendous concern. And we've seen indices really reacting to that. So overall, the economy it's all about political risk that could make the downward trend even worse. Well, the most important thing is perspective. So when we look at global returns, for example, and global growth and premium, it's important to contextualize what's happening here for our members in the United States. So the OECD came out with its latest numbers. Now, it takes time. It's longer for insurance numbers to be confirmed than it is, for example, for the economy, like we were just talking about GDP and so forth. So the most recent numbers that were released earlier this year by the OECD are for 2017. Then we have preliminary numbers for 2018, and we have some forecasts for 2019. So what's important here is that premium growth has been steady. It started closer to 4 in 2017, confirmed. It went about halfway to that, 4.5 and so forth, in 2018, and now we're expecting, the OECD is expecting that premium growth will reach 5% or maybe potentially more in 2019. So we have an overall positive trend there. An element that's interesting and stands out in the OECD report is the relative impact of equity exposure in terms of return. So traditionally, insurers are mostly, of course, on the fixed income side, but in some countries, namely France, the United States, Japan, and so forth, there's a much higher, about 25% versus 15% of exposure to equity versus fixed income. And that we've seen, and the report shows that those who have a higher exposure to equity actually have done very well up to now in the cycle. That may, of course, change if we go into a recession. III has been looking a lot at InsurTech, and what's been fascinating to learn from different studies, whether we were conducting work on insurance and resilience or looking at our training programs for the next generation of insurance leaders, is the sheer size of investments in InsurTech globally. We've actually had 3/4 of $1+ billion investment US dollars in InsurTech. That's never happened before. And one of the things that surprised me, for example, and my colleagues, is that it used to be, especially around emerging markets, that it was demographics, the emerging middle class, that would drive growth. So today, it's about technology, and that's what is very relevant to our members. That a lot of the ways that emerging market carriers have been able to drive growth is by looking at InsurTech channels, looking at digital improvements in processes and custom products and so forth. So I encourage you to read a few more details in the report, and we've also put some links there if that's something that interests you.